Why are there not more people talking about the US dollars in value, reaching heights not seen in decades? This has sent ripples through the global economy, impacting and
Understanding the reasons behind this dollar is crucial for investors and policymakers. The dollar reflects the stability of the U.S. economy. Amidst global, the U.S. market is seen as this has driven up the dollar's value.
However, this is not without its. While a strong dollar can benefit American, it can also hurt US by making more expensive.
The U.S. dollar index, often referred to as the DXY, is a key barometer of the greenback's strength. This index tracks the dollar's value against a basket of 6 major currencies: the euro, Japanese yen, British pound, Canadian dollar, Swedish krona, and Swiss franc. A rise in the DXY indicates a strengthening dollar, while a decline signals weakness. In recent months, the DXY has been on an upward trajectory, reflecting the dollar's surge. This surge can be attributed to several factors, including the Federal Reserve's aggressive interest rate hikes, the relative stability of the U.S. economy, and geopolitical uncertainties that have driven investors towards safer assets. The DXY's performance has significant implications for global markets. A strong dollar can impact everything from the cost of imported goods to the value of foreign investments. As the DXY continues to fluctuate, its movements will be closely watched by investors and policymakers around the world. The Federal Reserve, America's central bank, plays a pivotal role in the dollar's dance on the global stage. One of the Fed's key tools for managing the U.S. economy is its ability to set interest rates. These rates, in turn, influence the flow of capital both domestically and internationally.
When the Fed raises interest rates, as it has been doing in recent months to combat inflation, it makes U.S. dollar-denominated assets, such as bonds, more attractive to foreign investors. This is because higher interest rates offer investors a higher return on their investment.
This influx of foreign capital into the U.S. increases demand for the dollar, pushing its value higher. Conversely, when the Fed lowers interest rates, it can make U.S. assets less attractive, potentially leading to a decline in the dollar's value. The Fed's delicate balancing act of managing inflation while considering the dollar's global impact is a constant challenge. Section 4. Global trade winds, exports, imports, and the dollar. The dollar's strength has a profound impact on global trade, creating winners and losers in the international marketplace.
For American businesses that rely on exports, a strong dollar can pose a significant challenge. When the dollar is strong, U.S. goods become more expensive for buyers in other countries, potentially hurting sales.
On the flip side, American consumers often benefit from a strong dollar, as it makes imported goods cheaper. Whether it's a car from Japan or clothing from Vietnam, a strong dollar increases the purchasing power of American consumers looking for deals on foreign products.
This dynamic can create trade imbalances, with the U.S. potentially importing more than it exports. However, it also highlights the interconnectedness of the global economy, where fluctuations in one currency can have ripple effects across borders.
Emerging markets under pressure, the debt burden. While a strong dollar can create both opportunities and challenges for the U.S. economy, its impact on emerging markets is often more complex and potentially destabilizing.
Many developing countries borrow money in US dollars, attracted by lower interest rates and the stability of the greenback. However, when the dollar strengthens, these debts become more expensive to service.
This is because these countries need to earn more of their local currency to repay the same amount of US dollar-denominated debt. This can put immense pressure on their economies, potentially leading to debt crises.
The International Monetary Fund, IMF, has warned about the risks of a debt tsunami hitting emerging markets as the dollar strengthens and global interest rates rise. This situation underscores the need for careful debt management and economic policies in developing countries to mitigate the risks posed by a volatile global financial landscape.
Section 6. Commodities in the crosshairs: oil, gold, and the greenback. The dollar's rise significantly affects commodity prices, particularly for oil and gold.
Oil, the lifeblood of the global economy, is priced in US dollars. When the dollar strengthens, it takes fewer dollars to buy the same barrel of oil.
Gold, often seen as a safe haven asset, tends to have an inverse relationship with the dollar. When the dollar strengthens, gold prices often fall, and vice versa. Thanks for watching. If you found this video insightful, don't forget to subscribe, like, and share. Stay tuned for more updates on global financial trends.